Welcome back. You're watching The Drop here at AusBiz. Well, let's get to our next guest. Clifford Bennett from ACY Securities is standing by in our Barangaroo studios to answer the question, what did you make of the rally overnight? It was a bit of a wet lettuce leaf. What's your opinion about what we saw?
Good morning, David. Global markets, let's trade. Woohoo! It was one of those typical rallies where there's kind of a big economic fundamental event, which is very clear in its message. That is that US inflation is reaccelerating, core measures are reaccelerating, the Fed's going to be hiking really to the horizon and beyond. But it's almost as if within 24 hours that becomes yesterday's news, which is kind of accurate. But as if it's not going to have an ongoing influence on the main street economy of the United States and on valuations of stocks and their earnings. It's going to have a huge impact for a very long and extended period of time. And yet we get people going like, okay, but that was Friday, so now do you think the Fed might not hike this next meeting? People, there's a lot of people out there, traders, I'm sorry, but they haven't got the memo. It's as if they haven't got the memo. The Fed's going to be hiking another 4 to 8 times. That's what it's going to be doing. Do you remember when my forecast that the Fed would be moving up to a terminal rate of 5.75 to 6.5 seemed extreme? Well, now a lot of economists in the United States are joining that view at 6.3, 6.5 for a terminal rate on the Fed. And the market just constantly wants to believe what it wants to believe, that the Fed will soon be done if the economic data is bad enough, but it isn't at the moment. There was a little bit of a spike in January. I actually think that won't last. But we're looking at a weak, but well below trend, if not negative economic growth for a couple of quarters this year, whilst the Fed continues to raise interest rates. I mean, I'm doing a bit of a monologue here, but I think the real centerpiece of all of this is that inflation is winning the war with the Fed. The Fed and inflation are at war, and inflation is winning. And the Fed's already used an enormous amount of its ammunition. It's been very aggressive in hiking rates, and yet inflation's re-accelerating. And we haven't even seen really the full impact of global oil prices beginning to rally again. And if they continue to do so, and I think, by the way, that natural gas prices in the US just bottomed. I mean, if anyone's out there looking for an interesting risk-reward opportunity, I would look at US natural gas at the moment. But I think with those energy prices coming back, there's no room in the pricing or the profit margins of small, medium, and large businesses in the United States to absorb a re-acceleration of energy prices. And so they will be quickly passed on to consumers. So this re-acceleration we're seeing in inflation, it's going to continue. This means rates could even go beyond the top of my range at 6.5. So people need to understand this isn't a question of each Fed meeting, will they hike or not? They shouldn't have dropped so soon from 50 to 25, which, as I said previously, is going to elongate the rate hiking cycle well over the horizon. I hope that answers your question, David.
Now, Clifford, I was going to go and ask you, on that Fed policy, obviously a lot of the other movement at the moment has been done with the funds rate. What about the balance sheet? Because looking at where QT is up to at this point in time, it's way behind the schedule. We've still got a lot of liquidity sloshing around the system, which is probably explaining why the resilience in risk assets. Should the Fed be doing more with its balance sheet?
Oh, it certainly should, and I think it will be. So, I mean, it's one of the reasons I'm really quite bearish US bonds, and I think yields will be going higher there as well. And I think the bond market tried to look past a valley that wasn't a valley, but an actual huge ocean of low economic growth and ever higher Fed interest rates. And I think the Federal Reserve's very much aware now that really it's funds rate, as you say, isn't doing the job. It isn't winning the war against inflation. So they have to bring in the big armaments, if you like, the big super warships. And that could mean an acceleration in their bond program, bond buyback program. So I think that's a very good point that you make, David.
Clifford, you've got a background in FX markets. The US dollar, we've heard about the US dollar smile theory. It's supposed to go and really benefit the greenback when times are good in the States and when times are pretty tumultuous elsewhere. Given the situation right now, it looks like things are coming back towards the dollar, but really hasn't gone and managed to go and regain those losses that we saw earlier in the year in late 2022.
Yeah,
Where does
it's
it go
not as
from
straightforward an equation as it has been in the past. I think US dollar trading, I think Europe is actually bizarrely looking the firmer economy for 2023 than is the United States. And we're aware that, we should all be aware now that last year's slowdown was really driven by Europe and the United States. It was a Western economic slowdown, not so much the rest of the world. Of course, China was closed for COVID restrictions, but that was an anomaly. And I do think the rest of the world's going to be a bit stronger this year. What's surprising me is that Europe could be the stronger economic zone. And remember, the EU is bigger than the United States with all its members. So, you know, people still think the US, the world's biggest economy, the EU actually is. But what I'm trying to get to is I think there are arguments, fundamental arguments, to be buying the euro, because we know that the ECB could well be more aggressive in its rate hikes going forward than the Fed will be. And their economy has stabilized, taking into account the risks on the horizon there with Ukraine. So I think the US dollar is torn between two forces. That is its own weakening economy. Because we've had a momentary blip in economic data in the US, it's not going to be sustained. So we've had previous weakening, a momentary blip, it's going to continue to weaken. That's a negative for the US dollar. Massive trade deficits, negative. Massive fiscal deficits and spending, government spending, it seems completely out of control now. These are all negatives for the US dollar. The only thing holding the US dollar up is the old mistaken belief that it's still the safe haven. It isn't. If you want to play safe, you put your money equally in yuan, euro, and US dollar. But that safe haven status is going to wear off as all these deficits continue to grow. And the only thing that's really backing the US dollar at this moment is that they are hiking interest rates. But at what point do people stop saying, you know what, I'm getting a higher yield, but how much risk am I taking on an economy that is slowing, its property market is falling, its equity market is still in decline, and its bond market is in decline. Why am I in that currency? For the yield. Is the yield worth the risk? So that's the equation a lot of global fund managers are trying to work through at the moment. And it's a difficult, nuanced approach. I find my own views sort of modulating during the day, but overall at the moment, I think the US dollar is on a tear higher. So I think, but every now and again you get this cautionary price action, but I do think the US dollar goes up before eventually we have a long-term, very long-term, think in terms of 10, 15, 25-year recognition that the US economy is no longer the dominant force it was. It's still a major force, but now it's one of several, and the rest of the world is catching up, and therefore why hold so much of your wealth in the United States? And at that point, the US dollar falls 10, 15, 25%. That's over several years. So for the moment, I'm bullish the US dollar, but I've got this thing in the back of my head that perhaps the days of the mighty greenback are drawing to a close.
All right, so the sleeper trade longer term is to go and get out of the US dollar. Got it. Clifford, always fantastic chat, mate. You enjoy the rest of your day. Catch you soon.
Cheers, David.